Principles of Accounting, Chapter 8. In Chapter 8, we talk about budgeting. So, budget is really just a plan about how we're going to pay for the things that we want to do. What resources do we need? How much money do we need? How much money do we need at specific time frames? Most budgets are for a full year corresponding to our fiscal year. And then we also use what can be called a perpetual or rolling budget, also sometimes called a continuous budget. And this is every time we start a month, we add a month onto the end. So example, as we're ending February here and getting ready to go to March, then we would add the February budget to the end of our, so we're always updating the budget every month. An operating budget is generally a 1-year period. Continuous budget, as we said, is 1 month or a quarter as each month or quarter is completed. And a quarter is a 3-month period within a year. So some other things that happen with budgeting are, we're going to talk about operating budgets in this chapter, but later we're going to talk about capital budgeting in a future chapter. And capital budgets last over several years because they're paying for things like buildings and equipment and very high priced items that we have to plan more than a month or a year in advance for. So what is the purpose of budgeting? Well, one, it's a plan. We have to develop our goals and then create budgets about how we're going to achieve those goals. And then in the controlling portion, so remember in our 3 management activities are planning, controlling, and organizing. So the controlling part, this is where we look at our budgeted result, our budgeted information compared to our actual reports and find out how well we are doing at meeting our actual goals, and if we're not meeting our goals, why? All businesses benefit from the preparation of a budget and really looking at where their money is coming from and where their money is going out the door. Almost all entities engage in some form of budgeting. Governmental agencies and universities and churches have specific rules that are covered in government and nonprofit accounting. Their rules are usually different than public accounting companies that would be creating budgets. But the main purpose of a budget is to assess our operations and how we're going to pay for those operations. So why do we create budgets? For the planning perspective, it's to help us define goals and objectives and to communicate those plans. It helps us coordinate activities. So when we start getting into the different parts of an operating budget, how do we plan how much we need to produce in order to meet our sales objectives at any given time? Make sure that we have enough stock in for what our planned sales are. So that's what we're talking about, coordinating activities. So coordinating activities between the sales and marketing department and the production department. It helps us uncover bottlenecks. So these are places where we get stuck or have issues with throughput, how we allocate our resources. It helps us think about and plan for the future. So maybe we see extra money in a future month, or maybe we see that a product's demand is getting worse and worse and we're thinking about cutting that product. So then we start thinking about what things could we make in place of that product. And then the control. And the control is really looking at the actual results to the budgeted results, which we'll be doing over the next two chapters. In this chapter, we create the budgets, and then in the next two chapters, we talk more about that control perspective to look at how we can improve our operations and evaluate and reward our employees for meeting our planned goals. How do we create budgets? It is usually a combination of top-down budgeting and self-imposed budgeting. So top management sets parameters such as this is how much total money we have, or these are the types of things that we want to engage in over the next year or two. And the self-imposed budgeting, which is also called a participative budget, is prepared with the full cooperation and participation of managers at all levels. There are multiple reasons to involve managers at all levels in the budgeting process and not just have top managers or the CEO level write the budgets. And the reasons for that is because our frontline managers usually create better goals and objectives. They're already working there, they know what needs to happen, and they know what their team is capable of doing. So they're better at coming up with plans for that. Managers are also more committed to following budgets when they feel that they have input on them. They're also more likely with being okay about being evaluated against their performance on a budget if they help to write that budget. So if a budget is written by top management and then just handed to you and you're told to follow it, whether you agree with it or not, your performance evaluation is based on your ability to follow that budget. If you get to help write that budget, there's more ownership and buy-in at every level within the organization. Self-imposed budgets should be reviewed, though, to prevent what is called budgetary slack. And what budgetary slack is when we set goals that are very achievable. So instead of setting goals that are like stretch goals that we have to work a little bit harder to get, we set goals that we already know we can achieve, or sometimes even a little bit lower than that. So we build in this slack that gives us room to do worse than we know we can. That way our targets are all very easy to hit. And we don't want budgetary slack. We want to actually motivate our employees to reach a higher goal than before or create a better efficiency than we had before instead of building in that budgetary slack. So what is included in the master budget? This is an example of all of the schedules that are part of a master budget. All master budgets start with the sales budget. What are our projected sales for the upcoming month, quarter, or year? Everything else is built from the sales budget. The sales budget is the very first one to be completed in any budgetary process. So we go to our marketing team and our sales team and we ask them what their forecasts are. We use those forecasts to develop all of the other budgets. Our budget should answer all of these questions. How much money are we going to make? When do we make that money? Do our customers pay us in cash right away, or do we sell things on account that we get paid for later? How much raw material do we need to purchase at any given time to meet our production goals? And if we're not a manufacturing company, then how much inventory do we need to keep on hand in order to meet our sales goals? If we're a service company, we need to make sure that we're planning for labor. So how much labor do we need to have on hand in order to meet our service goals and our customer satisfaction goals? And how much money are we going to earn? As I said, in preparing a master budget, we always start with the sales forecast. From the sales forecast, we can prepare budgets for production, manufacturing, and operating expenses. Then once we have all of the budgeted schedules created, we can create a budgeted income statement, a budgeted cash receipts and expenses, and a budgeted balance sheet. Budgeted income statement and budgeted balance sheets are also called pro forma statements. So these are the statements that would be created if our budget went exactly according to plan.